my channel. Thanks for joining me in another video. So this is another Q&A video, and I'm going to answer a few questions about HELOCs. I'm going to bring them up here. I'm going to talk a little bit about credit scores for HELOCs versus fixed rate, and are HELOCs good for paying off other higher interest rate debts? But before I get to that, I'd just like to ask, if you like my content, please do the old like and subscribe. I appreciate it. Okay, so into the video. So minimum credit scores for HELOCs. Minimum credit scores sort of apply to most loans secured by real estate, whether it be a first mortgage, second mortgage, HELOC, whatever. HELOC, standing for Home Equity Line of Credit, is essentially works kind of like a credit card, but uses your home equity as collateral. So it is backed by your house, and if you were to default on the HELOC, your home would be in danger of foreclosure. But the fact that it is collateralized by your house actually makes it less of a credit hit on your credit because it's secured debt. So a little tidbit of info there. But in terms of the credit score, generally speaking, and this isn't a by-year thing, this is sort of historically, but it does depend on the lender. But I would say the widest range of credit scores is maybe going to be on the very low end, 620, 630, 650, maybe even the bottom, all the way up to obviously the perfect credit score of 850. Now, the higher the credit score you have, the more likely you will be approved for the loan, number one. But if you are approved, your credit score will dictate what kind of rate you get. The lower the credit score you have, generally the higher the rate you will get on the loan, with the idea that the bank is taking more risk on with your lower credit worthiness. So for that, they charge you more for the lending. Now, I would say that the kind of areas where you start to maybe pay more or less interest is, historically, in my experience, if you're 750 or above, you're going to get the best pricing. 720 would be another rung. 680 would be another rung. I would say 680 and above, you have a high likelihood of getting approved, assuming all your other financial criteria meet their needs. Between 620 and 680, it's definitely going to get more difficult to get approved. It's certainly going to depend on the bank and how flexible they are in terms of credit score. And below 680, you're definitely going to be in the lesser attractive pricing in terms of interest rate. So you want to, your credit score is just so important. And the thing about it is when you need it to be good. But all the other time, you're kind of not needing it. So it's easy to think that it's, somewhat inconsequential in your life. But for the major decisions, the major purchases, buying a house, getting a car, even renting a place, your credit score can come into play. It's just so critical. And if you are even below 700, people start to get skeptical. 680 is like, all right, maybe made a couple mistakes, but probably good. Below 680, people are like, something's up. Now, in terms of variable rate or fixed rate, if you're going for a HELOC, you're pretty much always going to get offered a variable rate. I never heard of a fixed rate HELOC. Maybe it exists, but it would be uncommon. So for the home equity line of credit, which is basically an open line of credit that you can draw out money out on and then pay off, but when you pay it off, the line doesn't close. The credit remains available. But the idea of it is, it's not a long-term permanent loan. It's sort of you use it some and then maybe you pay it off, and your goal is to keep the balance on it low, not necessarily use it as a long-term borrowing instrument, because that variable rate could potentially make it not so good as a long-term borrowing agent, and there's an alternative for that. That would be the HELOC, so a home equity loan, which I think historically might be characterized colloquially as the second mortgage. That is not a line of credit. That is a lump sum of money they give you based on the remaining equity in your house. Usually it's 20, 25, 30-year payoff. It's a fixed payment for that whole time, and it works the same way as your first mortgage, and that would generally be a fixed rate. They probably do offer variable rates for that because they offer variable rates for first mortgages as well. I generally always discourage people to do variable rates on your primary loan on your property, just so you can't, get surprised down the road with big rate hikes. So last question, is a HELOC a good financial product for paying off credit card debt? I would say yes. I mean, a lot of people get scared about using the equity in their house, to pay off debt because they see the equity in their house as, their long-term savings. And that's true. And there is a little bit of psychology there. But ultimately, if you owe money on a credit card, when you do the math with the credit card debt against the equity in your home, your net worth is what it is. So if you can take some of your net worth from the home equity of your home and pay off a much higher interest debt over here, you're going to be saving a lot every month on interest. And then also now the interest on the HELOC is tax deductible. So by and large, if people are carrying high credit card balances with very high rates, and today's, 20 to 30% on credit cards, that's insane. Whereas on a HELOC, you might have prime, prime plus 1, prime plus 2, which is going to get you in the 8 to 9% range. Plus it's tax deductible, so you have some extra savings there. I say take the equity, pay off the credit cards, and then work on paying off that HELOC as quickly as you can. You'll be able to pay it down faster because it's accruing less interest every month. Now, if you're the kind of person that's going to get the HELOC, go pay off the credit card debts, and then rack up the credit card debts again, or max out the HELOC on, discretionary spending, then I might say think twice, but, unless the only way you get out of these debts, in the long run with credit cards and so on is pay them off or file bankruptcy or something. So unless you're planning on not paying the credit cards off at some point in one way or another, then shifting where your kind of net worth equity is from one place to another ultimately doesn't matter all that much, as long as you're sort of disciplined and understand what you're doing. So those are my thoughts there. Hope that's helpful. I'll talk to you in the next one.